Thanks, Jeff. Thanks, Tom. So now that we've talked about the stellar performance that we've seen really across the board so far this quarter and this year as a whole, we'll kind of take a look at some preliminary flows numbers for both the fourth quarter and for 2012. Once again, we say that these are preliminary because we have not received all of our December asset data in, but it should be a good reflection on what we've seen so far this quarter and so far this year. So let's start with fourth quarter preliminary fund flows. The top line numbers, we see that mutual funds had about $200 billion in, and ETFs added about a quarter plus onto that, $40.8 billion. And $200 billion for mutual funds seems pretty good numbers, but the thing that really stands out when you look down at the chart below is, especially over the last 2 months, we'll talk about it a little bit more, but we had $143 billion in money market funds. So basically 3/4 of that positive flow coming in money markets, as investors really saw some concern in the last quarter due to the things that we've already talked about: presidential elections, fiscal cliffs, kind of list goes on, even though overall performances have been great. But let's go through the rest of the group for the quarter. If you look at the one group that continues to struggle, it's U.S. diversified equity, $28.3 billion out of mutual funds. On the ETF side, we still continue to see flows going that way, 8.4. But equity mutual funds across the board really kind of struggle, 3.7 out of sector and $2 billion out of world equity. The funny thing is that even though you see ETFs on the positive side, mutual funds on the negative side, if you look at both of those from an equity standpoint as a whole, it was basically a wash for the quarter. Can you say that all the money that went out of mutual funds went to ETFs? Well, probably not, but you definitely was probably some trading going on, a little bit of pair trading between mutual funds and ETFs. But again, equity as a whole on the quarter, pretty flat when you look at ETFs and mutual funds. Taxable fixed income really continued to be the story, $61.8 billion going into that group for mutual funds, another $6.8 billion for ETFs. Municipal debt, even though Jeff had mentioned we had a little bit of weakness towards the end of the quarter, end of the year, and we'll talk about it a little bit more, they still pulled in about $5.8 billion for the quarter, excuse me, and another $600 million on the ETF side. And mixed assets, again, as Tom had mentioned, we talk about mixed assets. A lot of them are fund of funds. There is some double counting sometimes that goes on in there, but we like to make that point that they have actually done quite well, and they continue to have strong flows in Q4, about $23.3 billion. And again, we'll look at the year numbers too to see those as Tom had mentioned before. So although a lot of it we're going to focus on today is going to be mutual funds, we also have talked, every quarter, and it seems like every year, ETFs need to become a little bit bigger part of the story as in both retail and institutional investors start using them more frequently within their portfolio. So looking at Q4, let's take a look at some of the largest and most frequently used ETFs out there. If you look across the board, it's very similar to what we've seen over the last couple quarters. SPY really stands out. We know that SPY is used heavily by trading desks as well, as is probably the premier ETF when people are looking to buy the U.S. market. Again, we saw dips going down probably through about mid-November, coming off the concerns from the election. But ever since that point, it's been really up, and up. And on the whole, on aggregate over the Q4, we've seen $8.7 billion going to SPY. Across the rest of them, pretty steady. Except for, again, the one that I really want to point out is iShares MSCI Emerging Markets. Emerging Markets, both on mutual funds, we'll talk about those in a second, and ETFs continue to draw a large amount of assets. And although it was relatively flat through the first part of November, we really saw some pickup in interest in emerging markets, again, both on ETF and mutual fund side, but with this specifically, the EEM product, $8.6 billion in. It seemed like investors, with the concern maybe in developed markets, considering the U.S. as well with the fiscal cliff, at that point really did feel comfortable going out into the undeveloped market, into the emerging market area. They maybe figured that maybe prices and opportunity was available there, but that if the fiscal cliff, the worst case scenario and some of the other things came out, that may have buffered them a little bit more from some of the outflow we saw or some of the outcomes we would have seen in the developed markets. iShares, the EFA product was pretty flat, a little bit down. We saw triple Q, $2.1 billion in outflows. Again, I think part of that story is what Tom had mentioned, where we really saw some lagging performance on the tech side. And one of the other interesting things is we actually saw $1.7 billion going into GLD. So again, I think this was part of the fear aspect. We saw that gold during the quarter lost about 5.4%, but investors continued to move money into gold products, partially I think due to some of the continued quantitative easing we've seen, and then also just the other part, which is just general concern across the board. If we look at ETFs so far in 2012, again, this is probably a pretty good number since we track ETFs a little bit and we got most of them in for the year, but basically $161.6 billion for the year. So that's pretty impressive. And we have seen assets over 1.3 trillion now, close to 1.35 trillion. So let's go back to mutual funds. Look at the USDE group equity for the most part, or equity for the most part. And look at the gainers and the losers. On the gainer side, it was pretty interesting. You know, we've really seen for the last year the top part really kind of being dominated, especially from yield plays. Equity income is specific, and really this time it's a much different story. We see multi-cap core of $4.4 billion and S&P 500 at $3 billion. And one of the things we have seen, especially in December, both on the ETF side and on the mutual fund side, again we're focusing right now on mutual funds, is investors really flocking to passive investments. Indexed funds. You look at multi-cap core, the big gainer there was the Vanguard Total Stock Market product. If you look at the S&P 500, still Vanguard and Fidelity Spartan 500 did very well. So investors towards the end of the year had some concern, wanted to keep that risk on, because I think that they felt that, you know, we'd seen such a good run so far this year that they really didn't want to sell out of their equity exposure, so they felt much more comfortable buying the market instead of really putting their faith in stock pickers. And then we saw dedicated short bias, $1.4 billion. So there were also some investors on the other side. There were some investors that did feel that with the fiscal cliff we might see the worst case scenario, and they wanted to position themselves for that. So we saw about 1.4 into dedicated short bias. The next group was sector, and for sector, it really was flat across the board. I think part of it goes back to what Tom was mentioning about really mixed performance, not very great performance in sector. If you look at the top three, not much movement for core. If you look at it, if you're thinking about a quarterly basis, nothing really over $1 billion, especially in miscellaneous. We saw $555 million. Much of the interest there was in global infrastructure type products. Natural resources, we saw $427 million, which is kind of surprising because, again, we saw really some weakness in the energy price and things like that. Well, really what this was MLPs, master limited partnerships, investors looking for yield and going that direction. And then global real estate, which has maintained as a good sector to go into, and we've seen decent performance on that side, $426 million for the quarter. World equity, again, we've seen two of the top groups that we've seen for the last few quarters. They did switch spots since Q3. Emerging markets took the top spot at $4.3 billion. As again, I said, investors both on the mutual fund and ETF side continue to flock to the non-developed exposure. And global flex, $2.7 billion. So these two groups have continued to be the top attractors of flows for the world equity group. And the international multi-cap core, $2.4 billion, again, was in the top three from last quarter. Once again, we see the same kind of story as we saw with the USDE, investors buying, the market going towards passive investments. The big gainer on that side was the Vanguard Total International stock. So, you know, Vanguard, Fidelity really have done well when it came to equity over this quarter as investors look to moving their investments to the passive side. On the loser side, oh, what can I say? I mean, it's the same story that we've really seen all year. If you look at the USDE and world, I mean, you might think that I forgot to update the slides because these are exactly the same as we saw in Q3. U.S. diversified equity, large cap core, pushed about $10 billion out, large cap growth, $9 billion, and large cap value, $5 billion. So almost $25 billion just in the large cap domestic space alone. Sector, going along with what we saw in performance of what Tom had mentioned as well, commodity, the general commodity, so diversified commodity funds, $1.5 billion out. Global natural resources, 1.4. I think they didn't have that same support as the domestics when it came to the MLP funds. And science and tech, $766 million out. Again, we know the story there. We had some real struggles, especially with Apple and some of the larger tech companies. World equity, similar story again to Q3, almost the exact same what we saw. International multi-cap growth, $2.6 billion out. International large cap growth, $1.5 billion out. And global large cap core, $1.2 billion out. So again, a lot of equity funds continue to struggle, especially diversified. So let's move on to the taxable bond fund side. This is also interesting chart that we see. You know, the top gainer of flows is similar to what we saw last quarter, almost exact actually. Intermediate investment grade debt funds pulled in $18.7 billion. That compares to $18.6 billion for Q3. So these are really the products that have been attracting the most money. Of course, within this group, we do have the PIMCO Total Return Fund. The second this quarter would be multi-sector income funds at $7.8 billion. That compares to $6.8 last quarter. So again, they continue to do strong. And then U.S. mortgage funds at $5.6 billion. I mean, mortgage funds have been doing really well. The two shining stars really in that group, at least when it comes to flows, have been double line total return and TCW total return. Both of those products have been attracting net flows consistently. And then the next one I really want to talk about I thought was somewhat surprising. We saw some added interest into loan par funds, $5.6 billion. And as we'll talk about with high yield kind of struggling, it looks like some investors that were moving away from high yield may have been trying to dip back to loan par so they could keep that goal of yield up, but $5.6 billion into that group. So that kind of takes us down to the bottom. And that was really the big surprise. These guys came in second for flows in Q3, Lipper High Yield Funds at $11.6 billion in third quarter. This quarter, $2.5 billion. Again, I think it came to the point that as Jeff mentioned toward the end, investors were looking at high yield. They were thinking that it was a little bit of expensive, kind of jumping out of that group. But they still did see, I think, about a 3% performance in Q4. So I think investors maybe were really positioning themselves toward the end of the year and maybe to the first part of 2013 with that group. The only other group that I thought was interesting is emerging market debt funds continue to do well, $2.6 billion in. And that did quite well for performance for the Q4 as well. So let's go to the municipal bond fund group. Again, munis have really had quite a stellar year. We saw basically through the third quarter only 1 week of outflows. For the first 2 months of the fourth quarter, we also saw strong inflows. October, $3.1 billion, November, $4.9 billion. And December, we see $2.3 billion out. The reality is that with the end of the year and concerns over how the taxes would come out with any kind of deal that came out of the fiscal cliffs, we saw both sides of the bet be taken. Really, when it came into November and early December, a lot of investors were flocking towards municipal debt with the idea that if income dividend tax rates would go up, municipals would be the place to go. With about a week towards the end, or a couple weeks, actually, I think it was the 2 weeks before the end of the year, some of the concern on the other side came to the top, which was in fact that, well, yes, these products will still probably maintain their tax advantage, but would it be at the same level as they had before? Would they basically cap the ability down to maybe 28% or something in that case? And we saw some investors flock out of the funds. But overall, 2012 was a stellar year, especially compared to 2011. 2012, we've seen roughly $47.9 billion in inflows. Last year, we saw $15.3 billion in outflows. So again, this year, we've only seen 4 weeks of outflows, 3 of them coming in the last 3 weeks of the year. So I think going forward, we'll see investors continue to flock to municipal debt funds. I think especially once we get any tax deals, once everything's clarified on what they're going to go with forward on that. So let's go to the last group. I know we're running a little low on time, and I do want to touch on some of the euros, so I'll try to get through this as fast as I can. So money market funds. Overall, we saw $143.1 billion coming in for the quarter. And so I just kind of split it out for you based on month as well as taxable versus tax exempt and institutional versus retail. So October, we saw about $4 billion going out. That was coming up into the election, which was somewhat surprising. So investors were putting money to work. And then November hit, the election came. We did see post-election that the market started to tank. I think we saw 5 weeks of downside performance, or 5 days, sorry. And then the markets bounced right back. But overall, investors put about $70 billion into money markets in November. And December, as the year came to close, I think some of that fiscal cliff concern continued to be in the market as well. So some investors, about $78 billion worth, decided to go to the sidelines and wait the end of the year out. If you look at taxable versus tax exempt, taxable obviously took the lion's share of the inflows. And then on the institutional side, we saw October for both of these charts were pretty flat. But institutional for retail, in November it was clear the institutions really were moving money aside to the sidelines. But in December it was almost split, retail and institutional. Really, it was kind of an even split between investors moving to the sideline, waiting the year out. Overall, on the institutional versus retail, institutional we saw $91 billion and $52 billion going for the retail side for the fourth quarter. So that was really the quarter. So what I wanted to do is run through just a couple quick slides to kind of take a preliminary look at the year as a whole. In 2012, we actually saw this was a great year for flows. Mutual funds, $316.5 billion. ETFs, $161.6 billion overall, almost $500 billion in inflows. And really where it came, as you can see, the middle and the largest graph, $260.8 billion to taxable fixed income. Investors continued, ever since 2008, we've seen this trend continue to go to bonds. They feel more comfortable as lenders. And this is despite two, and I would probably say 2 of the last 3 years of just absolutely stellar performance on the equity side. U.S. diversified equity continued to struggle for the year, almost $100 billion out, while the sector and world equity were both able to record positive flows for the year. So again, the big difference was the U.S. diversified equity versus taxable fixed income for the year. Going to the next slide, we'll really just kind of click on what we're doing is look forward. There was another slide in here, and I'll just go through them really quick to let you know what the top 5 and bottom 5 classifications were. The top 5 classifications for 2012, the top one was intermediate investment grade debt funds at $63.6 billion, high yield $26.8 billion, U.S. mortgage funds at $26.4, and short investment grade debt funds at $24.2. Multi-sector also had about 23.1. On the bottom, it's really what we expected the whole time. Large cap across the board, core, growth, and value. Large cap core 43 out, large cap growth 25 out, and large cap value 18 out. One thing I really did thought was interesting, because we have seen a lot of stories on it. When you talked about the large cap growth funds, one of the big fund companies and fund in specific that have really dragged that group down throughout the year is the the Growth Fund of America, American Funds product, and they had about $30 billion in outflow for the year. But the interesting thing I had mentioned to Tom and Jeff was, if you look at that product, it had over 20% positive gains, total return for the year. So as $30 billion was pulled out, that fund was able to return 20% in gains. So it was very interesting, and I think it is a good story for American funds that even though people were leaving, they were able to really rebound on their performance that we've seen the last couple of years. Looking forward, these are just a couple things that we'll be looking at with flows. I mean, the big thing I think is obvious to some people is ETFs will really continue to grow assets. We continue to see them become a bigger part of the story. And again, it's not only just because of their structure. I know a lot of people are flocking to them because also of the big campaign of ETFs and how they're marketed and how they're pushed by the advisors. But really, what we've seen is a larger use of them on the institutional side, and not just on the traders, but also on mutual funds themselves, actually investing in underlying ETFs to be able to take strategic positions and buy the market at a cheap way to utilize some of their cash, especially towards the end of the year. But I think we'll also continue to see, depending on regulatory issues, that ETFs will continue to become a larger portion of investable options for retirement plans. So I think that will be a big theme going forward. Second question really is, will active equity funds rebound? I think a lot of people, if you talk to them at this time last year, would have thought that this was going to be the year that they really did. I think that they had really had a hard time, and it was an uphill battle, especially when we see the type of returns and type of runs going to the next question that we saw in bonds. So with active equity, it's really been a struggle. We actually put a new poll question on our Lipper Insight, see what your opinion is on, equity funds, will this be the year where they rebound? But also kind of going back to the story on performance that we previously had, which was passive versus active. And also on Lipper Insight a couple weeks ago, I did put a breakout of flows between those over the last 2 years, is even though we continue to say on the aggregate that U.S. diversified equity funds have struggled, there really has been on the active side. Passive investment has continued to be strong, and we continue to see that going forward. So that's specifically why I kind of mentioned, will active equity bond funds rebound? And I think that they will struggle. I think there's 2 things that are really going to have to happen. One, I think we're going to have to see some weakness in the bond market. I think investors right now are not sold on going back to equity, especially when they're getting equity-like returns with what they would see as less risk in the bond market. But also, I think active managers really have to make the case. This year, as Tom, I think, had mentioned, and he had looked at as well, when you look at relative return, and I just remember a couple of numbers off the top of my head, if you look at it this year and you look at all equity funds versus their fund manager benchmark in the year, I think it was roughly around mid to upper 30% were beating their benchmark. Yes, that does take expense into consideration. When you look at the gross returns that take that, it goes up to more around 50%. But still, active equity fund managers have an uphill battle. So we'll really have to see if investors decide to go back in that direction. If you have someone like American funds offering 20% a year, maybe that'll happen. And then the third, again, how far can bonds run? It'll really depend. We'll see how they can go, how much lower yields can go. We did see that treasuries over the last couple of weeks have seen some upward pressure on the yields. And so going forward, I think that we may see a similar story to what we've seen this year. I think that passive investment, specifically ETFs for equities, will do quite well. World equity will do all right. But U.S. equity will continue to struggle, and people will continue going to bond funds as long as they see that the risk is low and they see decent returns there. So that's my piece, and we'll push it back to Tom.
All right. Thanks for joining us this morning. We appreciate it. We're over our time, but we'll certainly stick around and take any questions that you guys may have. I do want, again, just to reiterate that we will be having this PowerPoint presentation out to you by midday today. I'm hoping to have the replay up by tomorrow. Might be a little aggressive, maybe the following day, so maybe look forward for on Wednesday or Thursday. And then, of course, our next WebEx presentation is April 9th, 2013, so do put that on your planning calendar. And last, again, but not least, Matt made reference to it, we have polls every week in our new site. If you go to http:// whatever that is, forward or backward. Anyways, lipperinsight.thomsonreuters.com. There's no @ sign or anything else like that, so we would love to have you get on there and take a look at some of our new stuff. Is there a question there?
Yeah, we had just one last question, and I think the asker had left, but we'll answer it anyway. What type of mixed asset funds are attracting the flows? It's a real big mix. I mean, a lot of these mixed assets are coming through defined contribution plans. As we've seen that the default target dates, as we've seen target date funds become the default option, they've been highly used. But yes, the question was also focusing: is it global tactical allocation funds? And we have seen again a lot of flows going towards those products, the flexible products where investors and managers are looking for the globe as their investable universe. So we've continued to see across the board, target dates have done well, target risks have done well, but also specifically on a fund-by-fund basis, some of the larger ones have been the global tactical allocation funds.
Okay, well, so we'll give you a couple more seconds. Again, we'd like to thank you so much for joining us again this morning, this afternoon, or this evening, wherever you are in the world. And if not, again, we'll give you about 10, 15 more seconds. Got any questions? If not, we certainly look forward to seeing you next time, and thanks again for attending.